In the post-World War II period, there have been 18 bank or financially led recessions that have occurred. 5 of those are what we call the Big Five. In each one of these, there's been a very large run-up in either commercial or real estate prices, housing prices, prior to the collapse. In the United States, 35, 40, sometimes 50% increases. It takes about 3 years, 3.5 years on average, for real estate to work itself out of the decline and for prices to stabilize. Housing prices peaked in July of 2006, so you can do the math. Typically, stock market declines are on the order of 50% or so. Stock markets, as you know, come back before real markets, employment markets come back. But it usually takes 2 to 3 years, sometimes longer. Typically, unemployment from lowest unemployment to highest unemployment, that is the trough part, goes up about 7 percentage points. That would mean we started at around 5%. We're probably going to peak probably in the 11, could be 12%. It may be that unemployment slides down below 10%, but probably not for a couple of years.
I want to distinguish between a few markets that are, I guess, rip-roaring back and everything's fine, to some others that are not doing well. Some of the markets that have died I'm sort of happy about. And some of the markets that are doing well, they're probably doing well for the wrong reasons. And so the corporate markets we're all very happy with. The mortgage-backed security market is running at its old levels in terms of volume, but we have one little problem. The Federal Reserve has bought 80% of the new production mortgage-backed securities. There's a simple interpretation. They're paying too much. They're driving mortgage rates down as part of their policy. And I don't know if they have anybody whose job it is to lose money at the Federal Reserve. There is one nice little story. There aren't going to be any more home equity loans because no one has equity in their home anymore. I think the best news comes from the corporate bond market, where there is relief, and we are looking forward then to true recovery after this period of stabilization.
Recovery doesn't mean return. It's very, very tempting to think it means a return to where we were. Well, this one is different. When the US, Europe, Japan, the large countries drop fairly significantly, and other smaller countries continue to grow at a very rapid rate, you can see that creates almost like a tectonic shift, almost like an earthquake. It shakes the order of things. What we have come to expect our economic clout to do for us politically is also going to be changing in the new order. I think we'll probably see the dollar, just as one currency that most of us can relate to, the dollar against the euro at $2 per euro within 2 years. So if you're planning your European vacation, get it in now or start saving.
Everyone agreed that the financial system needed to be bailed out, but I can't imagine doing it in a poor fashion. You have the Treasury basically sitting across from the banks and the investment banks, and the investment banks are saying, you are not going to give us a haircut because we know you have to save us. And the reply should have been, well, that's true, but we're going to play chicken with you and maybe we'll let you fail. Unfortunately for the American taxpayer, Geithner and Paulson folded up like a cheap pup tent after about 15 minutes. They got all the downside risk of insuring the financial system and none of the upside. So I'm here to tell you there are ways to fix this, right? First, let's start with the fairness issue. In both world wars, there were windfall profits tax on ammunition makers. In the mid to late 70s, there was a windfall profit tax on oil companies. The tax worked because it was a surprise. I guarantee you it would be a surprise to Wall Street if Congress came up with a windfall profits tax. My proposal for dealing with the incentives going forward is basically General Motors. No one thought that you could take General Motors through bankruptcy in 6 weeks, but they did it. But they changed ownership. That's all bankruptcy is recapitalizing, saying you used to own it, you don't own it anymore. We need a sort of a even faster mechanism for financial institutions. The economy does not need certain people to own these firms.